Well, central bank leaders deliver a hawkish tone this week as messaging of rate hikes are not over and done with as investors might have thought. And Jay Powell pointing to further rate hikes this year, despite the recent pause, raising eyebrows on the Fed's judgment, perhaps, in some quarters. Here to discuss is Nancy Tengler, CEO and CIO of Laffer Tengler Investments. And she exists in one of those quarters that is questioning the Fed, right, Nancy? So talk to us about where you think the Fed should go from here and where you think it will go from here, because I'm guessing those are not one and the same thing.
Probably not, Julie. Thanks so much for having me. I think one of the things that stood out for me at the press conference was there was, as always with Fed Chairman Powell, a lot of contradictions. And so if you step back, I'm not sure which data they're depending on, but if you step back and look at the core CPI number that came out last month, what you see is that there were three components that comprised 99% of the total number. So shelter was 0.22%, used cars were like 0.15, and then you had car insurance at a fraction. But that added up to 0.43, which was 99% of CPI. We already know from the current data, I guess I should say, that housing has rolled over pretty materially. And I included a chart in my talking points that was from the Wall Street Journal. It just shows Zillow and a number of other current indices showing that housing is coming down. So that will start to show up in the CPI numbers. And then the Manheim used car index in June is running at a monthly rate of about negative 0.6%. And so I think once those numbers start to be reflected in CPI, we will see some meaningful decline. We already have seen a decline from 9.2 to 4. And if you think about historical inflationary periods, inflation has gone up mostly symmetrical and come down mostly symmetrical. So we're 15 months. It took us 15 months to get to peak inflation, and we're about 9-10 months into the downward trend. So I think the Fed would be wise to pause a little bit longer. And I would also just appreciate it if they'd all kind of stop talking and contradicting each other.
Nancy, as far as the messaging, I mean, is that partly intentional? In other words, allowing the central bank to have options at its disposal because of some of the very issues you mentioned. Yes, there is the data that's come out that points to sort of cooling down of inflation, and yet we keep hearing over and over from Fed officials that we're still in this lag period, and they don't have a clear picture of the extent of the tightening and the impact on the economy so far.
No, that's a valid point, Akiko. I think one of the problems is that, and it started Jackson Hole in 2020, I think it was, where they decided to become what they call data dependent, which is really another word for looking backwards. There doesn't seem to be sort of a guiding philosophy going forward. They've been laser focused on the labor market this time, and they were also laser focused when they neglected to start hiking rates for almost a year after inflation started. They were laser focused on labor then too, because remember, people were getting checks to stay home. The participation rate was not coming back, and so that caused them to continue to wait. And now they're kind of making the same mistake in reverse. And so I think one of the problems is that DC is not the United States. It's its own world. And so if you look at all the data that we're looking at, it seems like the work has mostly been done. And the danger is that the Fed hikes too much. I don't think 25 basis points is going to matter one way or the other. But I think this constant roiling of the markets is not good for investors. It's certainly not good for individuals who are trying to plan their lives around, rising interest rates and high inflation.
Well, but at the same time, when they say they're data dependent, I mean, even the concurrent data that you mentioned, some of it is mixed, right? And it seems to me that when we hear Jay Powell sort of trying to couch his language or maybe contradicting himself at times, it's almost as though perhaps he's being overly transparent, maybe, because he doesn't know. And I think that maybe a lot of the smartest people out there don't necessarily know what is the absolute right decision right now. I don't know. I mean, it's a tough job to try to figure this out.
It is. But, what we do know is that this was the fastest hiking regime since the 1980s. And if you looked at the way that policy was driven then, they're trying to avoid that, but it's a very different situation. And so I think when you have a sort of self-inflicted wound of letting inflation get out of control, and you've got fiscal policy, it's not all the Fed's fault, to be sure. And we've written a lot about this in Mr. Magoo's Washington. And then in my most recent piece, it's time to replace the Fed with GPT. Because I think what we've seen is a Fed that's unwilling to learn, but he's also been unwilling to call out Washington on all the spending. And if you look at when inflation really got out of control, it was when the American Rescue Plan was enacted long after we were getting vaccines and people were going back to work. So it fanned inflation further and created this problem for the Fed to try to solve. But they don't have to solve it in a vacuum. And I wish we'd see more rhetoric coming out of the Fed to Washington to kind of cool down the spending for a while.
Nancy, let's talk about what we saw in the equity space this week. A bit of a cool down, you could argue, at least within tech. We saw the sector see $2 billion of outflows in recent trading days, at least according to a Bank of America note. This all came, of course, after proclamations of a baby bubble formed by the latest rally. That's according to some analysts we've spoken to, Nancy. How do you view this latest tech rally, and have you been buying into it?
We've actually been trimming into it, Akiko. So I think I've said on your air before, we were adding to technology and consumer discretionary last fall. It was hard to do. It always is hard to do at turning points. We didn't know if we were in a turning point, but what we knew was we were getting tremendous valuations when you see a stock like Microsoft at $214 a share. I mean, that was the bottom. That's not necessarily where we bought it, but we just added to it. We added to a number of the names: Adobe. We added to ServiceNow. We added to Chipotle. We added a position in Tesla, Lululemon. The Tesla position came in January. But now we've been net sellers or trimmers of these holdings because they've appreciated dramatically. And we've been diversifying our purchases out into industrials that we think will be one of the next beneficiaries, though we do not believe that the tech rally is over, and we don't think it's a bubble. I was managing money in 1999 through 2002, that whole period. Many of those names were trading at 100, 130 times peak earnings. We're not in peak earnings, and the valuations are much more reasonable with a secular tailwind, not just AI, but cloud as well. And I'll just add that you're seeing from the companies that have benefited from AI, like a Broadcom, which we still like, and Oracle, they're seeing tremendous levels of growth in the next 3 to 5 years. And AMD CEO came out and said, they're going to see 10 to 25, 50% growth over the next 3 to 4 years.
And so we're going to get more to Tesla in just a minute, but when you look at some of the other large cap tech stocks, especially those that have been fueled by the enthusiasm over AI, where do you think we sort of are in that cycle, and where the stocks are going to go from here?
Well, Jill, I think the total addressable market is yet to be known, but it is going to be quite large. And I commend your viewers to read a piece by Mark Andreessen on AI, what it is and what it isn't. It's posted on their website. Do I think NVIDIA is somewhat overvalued? Yes. Did I think Amazon was overvalued for many decades? Yes, and I was wrong. So one of the things you have to learn in this business is how to adapt. And so what we're looking at is valuation based on our own proprietary metrics, and then we're looking at the total addressable market. And we're early days in this adaptation to AI. We know we still have a lot of room to run in cloud computing, and the combination of the two, which is what Oracle talked about in their earnings call, has proven to be quite compelling in terms of growth. So, let it settle in. You never want to chase these kinds of rallies, and we don't. Volatility is the friend to the long-term investor, and I think you'll get some better entry points in the coming weeks. But, you have to be willing to step in like we did in October, because you don't get many of these opportunities in the long run.
So, Nancy, that brings us to a stock that I know you've been bullish on for some time, and we're talking about Tesla. We saw the stock get 3 downgrades in 3 days, the very latest being a double downgrade by DZ Bank, shifting from a buy to a sell rating. Going back to some of these notes that we saw, we heard Barclays talk specifically about this outsized expectation on AI running ahead with the stock, when in reality there were still some challenges on the EV side of things. how do you view this recent run-up for the company? And you think investors are maybe getting a little too ahead of themselves, especially on the AI side of the business?
I do, Kiko. I think just as I thought last fall and into early January that the stock was just being relentlessly punished for no particular reason. I mean, you heard analysts come out and say, well, Elon Musk bought Twitter. He can't run 2 companies or 5 companies, whatever it is. And in addition, he's taken a political stance and people are not going to want to buy Teslas. I mean, that kind of nonsense scares people out of the stocks. And so what you have to do as an investor is you have to look at, is this management team visionary? The answer is yes. Has he been a good executor? Yes. He's got a fabulous CEO. The volatility to the upside and the downside has always been extreme in this stock. So you use it as an opportunity. When it gets out of whack like it is now, you trim it back. And when it comes back in, you have to have the courage to step in and buy it. I don't think some of these upgrades and downgrades have been particularly useful in the history of my career over 40 years. What you really want to do is pay attention to the facts that Wall Street present and then step in and use your own judgment on buys and sells. And so that's what we've done. And we will continue to hold it. We're not adding in here for sure. And if we get an opportunity to trim back, we will.